And today I will present how to maximize profits and minimize losses using intelligent stops. And like Renee mentioned, I have been a professional trader focused on equities and futures for the last 15 years. I trade Forex as well, but right now I have switched to futures, Forex, futures, the currencies right now. I have 10 plus years in investment banking, and I'm also the founder of TradeOutloud.com, which is a trading education firm that is specialized in educating individuals how to day trade and swing trade the futures and obviously the equities market. Also, I'm the designer of an institutional proprietary trading system that is based on price support resistance. And when we're talking about price support resistance, we're talking about way more than what meets the eye. So we're talking about multi-layers of support resistance correlated with specific trigger times, also specific price zones, chart synchronicity, a strict set of trading rules, and a 10-point scoring system that enables myself and my traders to identify trades with ease and entry locations, exit locations, etc. If you want to hear more about Trade Out Loud, you can visit our website for more details about our products and services. And also you can visit us on social media. We do post a lot of invitations to obviously to our events and other events, other trading events. Also, you can visit us on Twitter. I do post a lot of trading ideas on Twitter. Twitter is more real time, so if you have an account, make sure you follow us on twitter.com/tradeoutloud. Also on YouTube, I have started, and I have done this a couple of years ago, and I have restarted to post a market outlook that is always posted on Sunday. Take a look. Last Sunday, it was the first time after a quite long period of time where we have posted our bias for this week. Take a look and take a listen to that video and see where the market is trading right now. So that is a great idea on how we implement our trading strategies. I'm just back from the Futures Traders Expo in July edition 2018, and we had a blast. We had a great attendees and great presentation, great application. So I know that many of you guys were at Chicago, and I had the extreme pleasure of meeting you guys there. So let's talk about today's agenda. So today's agenda is about placing stops and the art of placing stops, and also intelligent stops and multiple functionalities. All right, so I'm gonna ask you very quickly right now, how many of you guys have been in a trade, have stopped out of that trade just knowing that the trade is literally going in your desired direction? There's a little bit of echoing going on here, okay? Is it just me, or I don't know? So how important is your, how would your trading day look like if you would not be using, any kind of stop loss, right? So it could be devastating, right? Because you have an allocated risk per trade, and you would go beyond that allocated risk per trade. So for a lot of traders, especially for beginner traders, this is going to be a very good presentation. So let's have an honest discussion about the mighty stop loss, right? So what does the stop loss do for us as traders, as day traders, swing traders, even position traders, right? We have to use a stop loss because number one thing that a stop loss does, it protects our capital, right? So it definitely protects our capital from major losses, and we only use an allocated amount. Number two, it helps measure the risk for each trade. How important it is to measure the risk. The risk is the difference between entry and the stop, right? And the calculated stop, the pivoting area, or wherever you may consider the stop. So you can actually have a good estimation on how much you can be risking per that particular trade that is setting up. The other thing is it helps position size. So it helps you position size, but only if you know how to measure the risk for each trade, okay? Also, the stop is basically a pre-planned exit, because in I would say compared to the entry, right? What is the entry? The entry is, because we talked about the entry and the stop, the entry is the only time, and it is the time when your capital is at risk. And you want to have a calculated risk for your each and every single trade, and that's why you need to have a stop, right? So the stop is basically a pre-planned exit. The stop strategy is the second most important part of the trade, because one of the most important part of the trades is actually visualizing where the entry is and when your capital is at risk. This element defines your risk and determines what? Your position sizing based on your account size. The stop should always be placed below pivots for long positions and above pivots for short positions. For those of you that are new here, a pivot is that V formation of a pattern. Whatever time frame it sets up, it can set up on a 1 minute or a 5 minute, or if you're a swing trader, it can develop on 1 hour or even on the daily. But that pivoting area, that rooting area, oftentimes associated with a bottoming tail, right? So you see the price flurrying down, and then you're seeing the price accelerate and then zipping back up, right? When it's hitting a support level, right? When it's hitting a support level, you're always seeing that flurry and evaporates back up. It pushes the prices back up, and then it rotates and continues higher, right? That is the pivoting. And that, when you see that on the chart, that is the first clue that the price has stabilized or has established a new support level. Once the stop triggers, and I want to make, so for those of you that are beginner traders here, I want to make it very clear. I often hear a lot of traders not handling the terminology and not having a good understanding of the terminology. So here it is. Once the stop triggers, so let's say you're in a long position, you're in the trade, you have a hard stop, your hard stop triggers, and then it is called, so the price crosses through your stop, yours called that you're stopped out. So you have lost your risk amount allocated for that specific trade. Now, when the trade moves in your desired direction, right? So you have your entry, you're placing your stop, your hard stop or soft stop or whatever stop you may be using. We're going to talk about these in today's presentation. And when the price is moving above your entry area, it means that the trade has started to work in your favor, okay? So the next thing that you should be doing is look at the technical chart pattern and see the locations where you may raise your stop. Now, as the trade is moving higher, and this doesn't apply only to futures, it applies to whatever you may be trading, any instrument you may be trading. So when the price moves higher, it is achieving a target area or getting very close to a target area, it is only natural that you're going to be doing what? Raising your stop, lifting your stop up, right? And when you're lifting your stop up, you're protecting your cash, you're protecting the money that you have earned on that specific trade. So when you're lifting the stop, when you're lifting your stop, the trade, let's say, keeps on going a little higher, and then it curves around and it drops and it triggers your stop, right? So what that is, it means that it has triggered you out, it has trailed you out of the trade. So you have not stopped out of that trade, you have trailed out. Remember that stopping out has the negative connotation that is associated with a loss in trading, and trailing out is associated with a positive connotation, which means that you are exiting the trades with profits. Now, the importance of the stop, having hard stops, okay? So having a hard stop. The pros, it keeps your losses to a set limit dollar amount, right? So it locks it in, okay? If you're going to risk, let's say $500 on a trade, you position size for that amount, and then what you do is you place in a hard stop, okay? So it limits your dollar amount, because if it should break below that stop area, right, it prevents you from losing more than your allocated amount, Okay, so that's very important for traders. It also acts as an insurance policy to prevent a bad trade from costing you too much and taking too much out of your pocket. Because if $500 was my allocated amount, I don't want to give it $700, or maybe I don't want to give it $1,000 and double it, right? So this is one of the pros. It keeps your money safe. Now, there are certain cons, and at times, oftentimes, and especially in volatile market conditions. And if you have been trading futures for the last 3 weeks, you have seen that, and actually throughout this year, beginning with February 1st, you have seen the volatility has increased substantially, especially in futures indices. And this is something that I specialize in, day trading futures indices, obviously swing trading as well. So sometimes it stops you by the tick or by the penny. And especially if you're trading the first hour is the most volatile hour. That is where the price discovery is. Sometimes hard stops accumulate 1 hour losses. What that means that your allocated risk amount, and this is terminology used by Van Tharp, which is, and by the way, if you're, I truly recommend his readings and his books. So he talks a lot about risk and reward, and he was a true game changer for me. So sometimes hard stops accumulate these allocated risk amount losses that throughout the day literally stack up, and it makes it very hard for traders to come back after, let's say, 3 to 4 or 5 losses, right? Stop outs. So at the end of the day, it's all about balance, and how can you stay afloat, and how can you stay in the game without having to stop out as much, okay? And definitely, and mastering the art of placing stops. All right, how many times, and I'm going to ask you again, guys, how many times has this happened to you? You found a great trade, you scanned, you found a great trade, you found a great setup, the trade triggers, and then immediately after it triggers, it just goes up very little, very, very little, and then it turns around. And guess what? It stops you out. And then, guess what? And guess what? It reverses, okay? It reverses. So why? Well, why does this happen, okay? Because you either have stopped out by a few ticks or points or trail to tight, okay? So in volatile markets, it is very difficult to have hard stops, because oftentimes multi-layers of supports or resistance are being tested, okay? Now, what if I told you there's a way to be and feel more comfortable in a trade? And in fact, I've used this exact technique yesterday in one of my trades, okay? If we have enough time, by the end of the presentation, I'm gonna bring up some charts and I'm gonna share that fresh trade from yesterday, okay? So how do you do this? Well, first of all, there's a secret to the whole madness of staying in the game. In volatile market conditions, and especially in the summer, in summer trading, and right now we're within summer trading, especially August and September, okay? These are very choppy months until we begin new earnings season. These are going to be very choppy months. So October is going to be basically, the best month to get back into trading. And actually, we're getting ready for the last quarter, which is the most active trading quarter. I have my best performance in the last quarter of the year for years. So how do you do this? First of all, and this is again great for volatile markets, and this is fantastic for the summer period, and this is also great for around holiday trading. We're going to get closer to September. We're going to get closer to Labor Day, a week before or a week later, a week before or a week after Labor Day is a great idea to incorporate the strategy. Also, we're going to trade towards Thanksgiving, towards Christmas, towards New Year. This is great idea to use for your trading. But how do you do it? How do you stay in the game a little bit longer, and how do you give yourself that little bit of a room? First of all, reduce your position size to half, okay? So if your risk per trade, if you're a beginner trader, you're probably going to risk, I don't know, but let's say, I'm going to just say an amount, $500 per trade, right? And you obviously, if you're trading futures, so you're going to risk about $500 per trade. When your risk is $500 per trade around holidays or within the summer vacation time, use half of your risk, okay? Use half of your risk. That is literally going to provide you with another important element, meaning you're going to have more room for your stop, which means that you're going to be setting your stop. So when you identify a trade that pullback buy, let's say if you're in an uptrend, you're going to look obviously for pullback buys. You're going to identify the entry. You're going to identify the exact stop, obviously, the bottom of the pivot, include the wiggle rooms, position size. And if that should be around, because when you're trading futures, that could be like $440 or $475. So it's within that $500, okay? Do not exceed the $500. But within the summer period, like I said, reduce that to half. So you're going to be risking only $250 if you're a beginner trader. Now, listen carefully, because this can make you or break you as a trader, the position sizing. Oftentimes, I have traders that come to me and say, hey, you know what? I just blew my account so many times. It's like, why? Why are you blowing your account? And then they're showing me what they're doing in my coaching sessions. And then they're showing me what they're doing. And they're taking trades sometimes with $200 risk, and sometimes they're taking trades with $800 risk. Now, this is insane, okay? This is insane. You have to have a set risk amount. And it's super easy, because guess what? If you don't find a trade with that half of your position size, let's say within $250, you have to skip that trade and wait for another trading opportunity where you can actually use that risk, okay? So it's all about balance, okay? This will take a lot of pressure off of you, and you will learn to stay in the trades for a longer period of time without being emotionally involved. Now, as traders, when you have skin in the game, you become emotionally involved, because we're trading the most precious commodity, which is what? Money, okay? Which is money. So it is easier to stay in the trade if you're going to apply this principle, especially for the summertime. It's called the summer doldrums, guys, and we're full throttle into them. So use half of your size. So when you're going to use this, again, when the market is volatile, when the market is choppy, okay, when you're getting a choppy market environment, let's say today's trading session, if you're looking at futures, they're grinding up, they're grinding down, there's a strong divergency, Russell is down, you have the E-mini Dow that is up, you're having a flat E-mini S&P and pretty flat NASDAQ, okay? So this is the best time when you're gonna navigate a little bit to the higher time frames, because the lower time frames in this market environment are gonna chop you to pieces. That's what you're going to be doing. You're going to be forcing trades. Everything is not going to work. And this strategy will also help you if you're on a losing streak. Let's say you had a 1, 2, 3, 4, 5, 6, 7 trades. You have lost consecutively on these 7 trades. Guess what? You're going to be reducing your size. So you're not going to be risking your $500. You're going to be risking $250 and work yourself back up. This method will allow you to reposition and to re-add back into the game if the trade is going to shift from chop to a trending direction, whether up or down. So when you see higher highs and higher lows, or lower lows and lower highs, you get in the trade using half of your position. And if you see the trade cooperating, moving in your direction, hitting your target 1, hitting your target 1.5, and pulling back to the break-even zone, that is when you're going to add another lot, okay, back into the game. And therefore, you're going to keep on reinvesting. Or if you're trading a range, you're going to add half at the bottom of the range. And as it's executing the breakout, you're going to add the other half in. But you already made up some cash, and you're already sitting on some cash from that bottom of the base to the top of the base. So you're basically covered at that breakout zone. Now, when you use a smaller position size, you will not have the tendency to micromanage that trade. You're not going to go like, oh my God, I got to squeeze in 5 ticks. I got to squeeze in 2 points. Okay. You're not going to be as anxious, and you will get definitely into the habit of making money. Now, how many types of stops are there? Okay. There's a hard stop. The hard stop is a price level that, if tapped on, will trigger an order to sell or buy, right? Depending on whether you're long or short. And it's a trigger to get out of the trade. Hard stops are used to protect us as a trader, basically the capital that we're using, in case of a reversal. And this is going to limit our risk. Okay, so hard stops are great. I typically like to use hard stops when I'm using higher time frames. When I'm using smaller time frames, such as the one in the 2-minute charts, right off the open, I like to give them a little bit of room. So that's when I use, guess what? I use a flex stop or a soft stop. What kind of stop is this? Well, this is a mental stop. So the order is not placed on the brokerage account. The position open with no offsetting order to control the loss. This is what it is. A stop order, therefore, is not placed, but the trader still has that level in mind where he or she will exit a losing position if reversal occurs. Okay, if reversal occurs. So what that means is that when you're looking at pattern identification, and when you're looking at an entry, when you have your stop already set, right, your stop in mind, that is going to be a hypothetical stop, a flex stop, meaning that you can balance it out. You're going to keep that stop in mind. Okay, you're going to keep that stop in mind. And more about this in the next slide. What are some of the advantages of the soft stops? One common frustration for traders is setting a stop level, then having that stop order triggered, stopping you out with a loss, only to see that the instrument quickly recovers and moves into the desired direction that you initially initiated the trade. So this can be avoided by using the soft stops, okay? There's also a trailing stop, and a trailing stop is applied only if you're dealing with a winning trade. The trade has triggered, obviously it's continuing whether higher or lower in the desired direction. By applying this technical trailing strategy, the trader has planned to manage the open position so that he or she can book or lock in profits as the price is moving towards its target. So he's locking up profits. Okay, this is how a hard stop looks like. You can see the entry right here. I'm a very active futures day trader. So this is with one contract. This is my entry at the 28.05. And actually this was like 3 weeks ago. It was on the 20th. And not that long ago. And you can see where I'm placing my stops, right? You can see where I'm placing my stops. So my stop is right here at the 28.08. So I'm giving it, even though it is a hard stop, I'm not placing it right on top of the pivot and not really right on that resistance line or support line. And this is resistance in this case up here, because I want to give it that wiggle room. Remember that when we're discussing support resistance, we're discussing areas and not exact numbers, okay? Now, this is a soft stop, and this is also called an intelligent stop. And this, for this kind of stop, I use an alert, okay? because I want the alert to give me a heads up in case I'm looking at other trades. I may trade multiple instruments at the same time. So in case I'm not watching this chart, I don't want this price in case of a reversal to start flying higher. And then when I look at my chart, I'm go like, oh my God, okay, oh my God, no. Like I said, you know, there's no praying in trading, okay? And you're definitely, what I do, I place an alert. They're very easy to place. I also receive notifications on my phone. They flicker up on my phone, and they do have the sound alert. So it draws attention to your screen. Even, let's say you want to take lunch break, you're still in a trade right now, you want to give it a soft stop, but you still want to go, you know, go for a walk, or do you want to go have some lunch? Guess what? With modern technology, you can do that because you have your platform on your screen. Okay, you have your on your smartphone. You're going for a walk, you're taking your smartphone, and you're getting the alerts, and you can exit the trade, or you can add to your trade. A trailing stop. A trailing stop means that you have already entered the position. You can see the entry here, 67.92. Okay, so this is the entry position here. It is a pullback with a 1 minute buy in oil at this point, 67.92. At this point, the stop was below 67.90 over here. Okay, but because the trade has triggered and it has already achieved my target one zone, which was into the $68, I'm raising my stop, right? So by raising my stop, what I do is I actually lock in profits, okay? Now, using soft stops with a market tempo, you have to be very accurate when you're using stops, and especially when you're initiating positions. So how does the market work? Number one, there are certain reversal times and trigger times in the market that you have to be aware of. And I'm going to explain to you in the next slide how the market works. Usually around the major, one of them, I would say the most powerful reversal times comes at 10 o'clock. Okay, so 10 o'clock, if you're having an extreme rally, you can expect to short into 10 o'clock. Okay, for a scalp, or you can look for a pullback to happen at around 10 o'clock. So these are the reversal times. 9:45, when you're going to expect reaction in the market. And in the next slide, I'm going to explain to you how this market works and what to expect from these reaction times and from these trigger times. So reversal times are 9:45, 10 o'clock, 11:30, and 2:30. These are the best reversal times when you're going to see pullbacks happen. And based on these pullbacks, you're going to be looking for entries, especially in trends, right? Whether whether your instrument is in an uptrend or a downtrend. And there are precise trigger times, and these are proprietary for my trading method. And I look at market synchronicity and divergency. And by the way, very weak Russell right now. But the trigger times are 9:32, 9:35, 10:30, and 11:45. I specialize in trading futures at the New York session open. So these are my times. These are my precise times, and I correlate them with the market activity. This is what you can expect. The market opens, and let's say you have a day like yesterday when the market shoots straight up. Well, yesterday was literally a crazy day because the market shot up from literally 9 o'clock until 4 o'clock. Okay, so it was a straight vertical line like this. Okay, but this is not your ordinary market environment. Okay, because usually the market opens at 9:30. It rallies into 10 o'clock, and this is for uptrends. And then it pulls back into the 10:30. Depending on how shallow or how steep this pullback is, the reversal is going to come close to 10:30, give or take 5 to 10 minutes, and then you're going to see the trend continuation into 11:15 to 11:30. And then that's when you're going to expect the next pullback in the market. So rallies that happen from 9:30 to 10 o'clock are going to be a little bit briefer than the rallies that are going to continue from 10:30, because the market has picked a direction into 10:30, and most likely if we break the 10 a.m. highs after 10:30 closely after 10:45, the market has the potential, whatever market you're trading, whether you're trading stocks or you're trading indices, they will continue higher. Now there's the second scenario where you're getting chop. Okay, now we pretty much had this chop throughout the trading session today, right? And when this chop happens, okay, you're pretty much going to have a sideways market between 9:30 and 9:45. At 9:45, you're going to see an immediate reaction based on what? Based on the first reversal time in the market, where the market is going to shoot up into 10 o'clock. And then from there on, you can expect a pullback with a reversal that is going to take the market back into the new highs, into 11:15 to 11:30. So let's talk about hard stop versus soft stop. So when to use hard stops? When your E-mini, commodity, stock, ETF, etc., whatever you're trading is into an established trend. So soft stops should not be used in choppy markets. In choppy markets, you should use hard stops. So I'm sorry, it's the other way around. Okay, so when you have the market that is into an established, I wish I had a marker, is into an established trend, making higher highs and higher lows, that's when you're going to be using hard stops. When you're having a choppy market environment, typical for today, so today's market, especially when you're looking at the E-mini, Dow, S&P 500, and NASDAQ, and even Russell, when you're having this choppy price action, it is great environment to use. It is a great environment to start using soft stops. Okay, because this is what is a choppy market? A choppy market is a market that is ranging, and it's a market that has multiple levels of support resistance that are very tight together, and they're trading in strong confluence areas. All right, let me show you an example of a trade that I've done in the trading room about 2 weeks ago. We looked at Russell, okay? So we had a trade in Russell, entry long at 1700. Okay, here's the trade with a stop at 16.99. Why did we pick this trade? Because it was setting up here, okay? You see the trade. So this was, let me see if I could get this pointer here. Okay, I don't know if you guys can see it. This was our initial entry right here at 10:30. You can see it right here, the big arrow at 10:30, bottom of the range at 1700, okay? Now, the soft stop area is gonna be what? The 16.99. Why did we pick this support level? Well, take a look to the left-hand side, okay? This was our entry, okay? This was our entry, okay? And we picked our stop at 16.99. I'm gonna show you exactly in the other slide why we picked this number. So because our stop area was only 1 point away at 16.99, we decided to give it what? A flex stop. And I'm going to show you exactly in the next stop why. So remember, this trade is along at 1700 with a stop at 16.99 for 1 point stop, 2 minute time frame used in this particular case. Now, remember what I said, that our entry is at 1700. Why? Because it has come exactly into this area of support. It's also a psychological level at 1700, right? And the stop was 16.99. We were going to give it a 1 point stop, right? But why did we give the extra 1 point stop? Because of the prior low. And by the way, this is a 5 minute chart. This was our trigger at 1700, and this is the support level right here at the 1698. So when we initiated the trade at 10:30, Russell was trading right here where my cursor is, right here. And then it had the sudden drop, okay? And then when we entered, we were only giving it 1 point. But after it has triggered, it reversed, and push lower. If you do not have a good understanding of support resistance, you cannot trade this market. Okay, so you have to look for clues on the left-hand side of the chart that is literally going to show you where you need to place your stops. And this is how we came with the 1698. So we were risking 2 points on this trade. And obviously we were establishing the target levels, and the target levels, first target level was into the 1703, and then we had the 1706 and 1707, which you can see that they were fully achieved. Okay. Also, you have the option as the trade is moving against you. Remember that I spoke about the opportunity of a possible add to the trade. So based on the reversal on a higher time frame on the 5-minute, you broke below support, you landed in the secondary area of support, the price rotates back up above the prior price high, 16.99 right now becomes a trigger versus a stop. You add in one more lot and you place your hard stop, in this case at the 16.98. So remember, 16.99 was the soft stop. All right, let's move forward. Okay, let's move forward. Double support right here. So how does the trade look like? Remember, this is another trade, and this is, I took snapshots as the trade was going and it was working into our target levels, right? So you can see it right here, 1706, 1703 was achieved, 1706 was achieved, 1707 was achieved, and I was out, 1707, done. And I was done for the day. Okay, and I was done for the day. So we were risking altogether 2 points in this trade, 2 points, and achieved 7 points. Okay, all right, so let's do the math. The entry is 1700. I'm sorry, this is a typo right here. 1698 is the hard stop, the final stop. Remember that I always place a hard stop at a major support level. Okay, so even though I use a soft stop and I at the trade initiation, after I see the pullback, after the first rotation of the pullback, especially in day trading, you put in a hard stop underneath it so you limit the risk. And I typically 98% of the time add to my position. So the trade was a 2-point risk. That is $100 if you're trading with one contract. If you're position sizing with a risk of $500 per trade, you could take this with you could take the same trade with 5 contracts and position size for that. And the profit for this trade, $17.50. So it was definitely 3 times your risk. Okay, 3 times your risk. When to use intelligent stops? Well, in trending markets, and when you have really good, reliable in trending markets, and when you have good patterns that you can add on, and in sideways patterns, in choppy market environments. Now, you're going to ask me, intelligent stops will stop working when the trends are changing. Okay, so when you're having that wash out, wash in, you're going to see that these stops are not going to be working. So are intelligent stops riskier? Yes, if you don't know what you're doing and if you don't have a good understanding of technical analysis. But if you use half of your size, no. And as you have the rotation on the secondary support resistance level, whether you're long or short, you are placing your hard stop. And so right now you have a total hard stop underneath the secondary support level. If you're using the full stop, the ad will stand as if that is another trade. Okay, so remember, instead of stopping out and taking the trade again, if you have 2 support levels that are close by, you're going to add as if it's a separate trade, right? If you would have stopped out of the initial trade, okay, and then you're going to be looking at the same instrument to get in long again or short, depending on the case, right? Would you get in if it fits your criteria? Yes, it would. So what is the difference here? None. Okay. So basically, intelligent stops work about 75% of the time. We're offering Power Income Day Trading Futures class. It is starting on Monday. If you want to learn this technique, and if you want to learn, obviously, everything that is to know about day trading futures, I specialize in day trading futures indices, gold and oil, and swing trade the rest of the commodities. This class is live online, and it is a 30-day boot camp. It is from August 6th to September 10th. We teach you the most powerful day trading chart patterns and how to exploit them for above average gains. We teach you the 6 major disciplines for every trade, how to calculate entries, how to calculate stops, how to calculate target levels, how to manage the trade. What happens if the trade triggers? What happens if if the trade hits your target 1? What do you do then? What happens if your trade hits target 2? What happens if you hit a stop? So we teach you everything there is to know about this. We teach you the market tempo for the entire 24-hour trading, and that is for the futures market. You can exploit this for your stock trading, for your options trading. You can use this for Forex trading as well. How to maximize your timing using key moving averages and other really powerful indicators that are for free on present on any platform. How to maximize gains and minimize losses using proper money management techniques, market timing, precise timing, when to act, when to buy or to sell, precise locations, again, and really advanced technical analysis. Really advanced technical analysis. And when I speak about technical analysis, we include everything from Fibonacci's to multi-dimensional support resistance, et cetera, and way more than that. So if you're interested, shoot me an email at info@tradeoutloud.com. I'm more than happy to offer you details in the full class curriculum. And also included, you're going to have unlimited live retakes. I teach the class every single month. So you're going to have these live retakes. I don't believe that you can learn how to trade by reading a book or by watching a DVD. You definitely have to have someone that is going to teach you and someone that is going to be there to support you. This way, you meet with me every single month for 5 days. You're going to be with me. Within these 5 days, you can ask any question. Consider this as your own personal mentoring or coaching along the way. You have unlimited access to me 24/7 with any email. You have the manual, which is over 400 pages, platform layout, workstation initiation. So remember, the boot camp is a 30-day boot camp. It starts on Monday, August 6th through September 10th. It is from 6 p.m. to 8 p.m. Eastern. And we have the live trading lab. We're going to be trading with me, live trading August 10th through September 10th. So for more information, class curriculum, shoot me an email at info@tradeoutloud.com. We'll also have a trading room that is open every day from 9 o'clock to 4 p.m. Eastern, where we day trade futures and we swing trade stocks and futures and stocks and futures, obviously indices and commodities, etc. So if you're interested on that, shoot me an email. My email, you can find it here at the bottom of the screen, info@tradeoutloud.com. We also have a transparent portfolio on our website under the trading room tab.